You think you live in a democracy? You vote, you pay taxes, you follow the rules. But somewhere in a glass tower in Manhattan, in a meeting room in Basel, Switzerland, in a quarterly earnings call, nobody watched. Decisions are being made that will change the price of your groceries, the rate on your mortgage, and whether your job still exists next year. And you were never in the room. Most people believe the economy is controlled by governments, that presidents and prime ministers set the direction, and the rest of us follow. But the real answer is more complicated than that. And once you see it clearly, you can't unsee it. Think about the last few years. Inflation hit levels most Americans hadn't seen since the 1980s. Grocery bills climbed, rent climbed, gas climbed. And at the same time, the stock market, after a brief crash, hit record highs. That combination felt wrong to a lot of people. Your dollar was buying less, but somewhere, wealth was piling up faster than ever. In 2021 alone, U.S. billionaires saw their collective wealth grow by over $1 trillion. Meanwhile, 60% of Americans were living paycheck to paycheck. People ask the obvious question, who is making these decisions? The honest answer is that no single person is. There is no one villain, no shadowy figure in a dark room pulling every lever. But there is a system, a network of institutions, incentives, and structural rules that shapes the economy in ways most people never learn about. And understanding that system, even partially, changes how you see everything. Tyler is 31 years old. He lives in Chicago, Illinois, and works as a logistics coordinator for a mid-sized shipping company. He makes about $58,000 a year, a salary he's genuinely proud of because it took him 6 years to get there. Every month, his paycheck arrives, and within 48 hours, most of it is already spoken for. Rent, $1,450. Student loans, $340. Car payment, $280. Utilities and groceries, another $400. By the time he's covered the basics, Tyler has maybe $400 left for the rest of the month. He tries to save. He has a small 401k through work, and he contributes just enough to get the employer match. But last spring, his car needed $1,100 in repairs. That wiped out 4 months of savings in a single afternoon. Tyler isn't irresponsible. He isn't lazy. He's doing almost everything right. But no matter how carefully he manages his money, he can't seem to move forward. He feels stuck, not because of anything he's done, but because of something he can't quite identify. He keeps hearing terms on the news: Federal Reserve, interest rates, BlackRock, the IMF. They sound important, but nobody explains how they actually connect to his life. So he keeps working, keeps trying, and keeps wondering why the gap between effort and progress never seems to close. Here's the first thing Tyler, and most people, were never taught. The global economy is not managed by governments alone. It is co-managed by a small number of institutions that most people have never seriously thought about. The first and most powerful is the central bank. In the United States, that's the Federal Reserve. In Europe, the European Central Bank. In Japan, the Bank of Japan. These are not government departments in the traditional sense. The Federal Reserve, for example, is a quasi-private institution. Its board is appointed, not elected. And the decisions it makes, like setting the federal funds rate, ripple through every corner of the economy. When the Fed raises interest rates, borrowing becomes more expensive. That means higher mortgage rates, higher credit card rates, slower business investment. When it lowers rates, cheap money floods the system. Asset prices rise, stocks go up, real estate goes up, Tyler's rent goes up. Here's what makes this so significant. The Fed made the decision to keep interest rates near zero for over a decade after the 2008 financial crisis. That single policy inflated the value of assets, stocks, real estate, bonds, by trillions of dollars. People who owned those assets got dramatically wealthier. People who didn't own assets, like Tyler, mostly felt the effects through higher costs. The same policy. Two completely different outcomes, depending on where you were standing when the music started. But central banks are only part of the picture. There's a second force operating at a scale that even many financial professionals rarely discuss. Asset managers. Three firms, BlackRock, Vanguard, and State Street, collectively manage over $20 trillion in assets. To put that in perspective, the entire GDP of the United States is around $27 trillion. These three companies are the largest shareholders in most of the Fortune 500. They own significant stakes in Apple, Microsoft, Google, ExxonMobil, JP Morgan Chase, and thousands of other companies simultaneously. This creates something economists call a common ownership problem. When the same investor owns competing companies, the incentive to compete aggressively is reduced. Why would a major shareholder want Ford to crush General Motors if they own both? This dynamic, playing out across the entire economy, influences pricing, wages, and competition in ways that regulators are only beginning to understand. And it's not happening through fraud or conspiracy. It's happening through the perfectly legal accumulation of capital operating through index funds. The same index funds that financial advisors tell ordinary people to invest in. The system isn't hiding. It's just very, very large. Now let's zoom out even further. Above the asset managers and the central banks, there's another layer. Global financial institutions. The International Monetary Fund. The World Bank. The Bank for International Settlements. These organizations were created after World War II, designed to stabilize the global financial system and prevent another Great Depression. The Bank for International Settlements, based in Basel, Switzerland, is particularly fascinating. It's sometimes called the Central Bank for Central Banks. It coordinates policy between the world's most powerful monetary institutions. It's largely invisible to the public. Most people have never heard of it. Yet the decisions made in its meeting rooms in Switzerland influence interest rates, currency values, and lending conditions on every continent. Here's the critical insight. None of these institutions are elected. None of them are directly accountable to voters. They operate with enormous technical expertise and genuine good intentions for the most part. But they also operate with built-in assumptions about how economies should work, assumptions that tend to favor stability, creditor protection, and the primacy of financial markets over other social goals. When the IMF lends money to a struggling country, it typically comes with conditions. Cut public spending, privatize state assets, liberalize trade. Whether those conditions help or harm ordinary people in that country is a matter of serious academic debate. But the conditions get set regardless. In 2010, when Greece faced a debt crisis, the terms of its bailout required severe austerity measures. Pensions were cut. Public sector wages fell. Unemployment hit 27%. The decisions were made in coordination between the IMF, the European Central Bank, and the European Commission, none of which Greek voters had directly elected to make those choices. Let's come back to Tyler. He's not thinking about Basel. He's not thinking about the Bank for International Settlements. He's thinking about his car payment and whether he can cover rent if something goes wrong next month. But here's the connection. The interest rate on Tyler's student loan was set in a world shaped by Federal Reserve policy. His rent is high, partly because a decade of near-zero interest rates made real estate an irresistible investment for institutional capital. His wages have grown slowly, in part because the labor market operates in an economy where major industries share common ownership at the top. None of this is Tyler's fault. None of it is the result of him making bad decisions. It is the structural output of a system operating at a scale most people aren't taught to see. And here's the deeper realization. The people who benefit most from this system are not necessarily smarter than Tyler. They're not harder working. They're not morally superior. They simply started inside the system, or were taught how to read it. Legacy wealth means starting with assets already in place. Stocks, real estate, capital that compounds while you sleep. Access to elite networks means knowing which institutional investor is shifting capital before the news breaks. Understanding monetary policy means knowing that when the Fed signals rate cuts, certain assets reliably rise. This knowledge is not secret, it's just not taught. The curriculum in most American high schools and colleges spends almost no time on central banking, institutional investment, or global financial governance. People graduate, enter the workforce, and encounter a system they were never equipped to understand. Tyler will probably work hard his entire life. He'll try to save. He'll make reasonable decisions. He'll do what he was told to do. And for many people like him, the gap between effort and outcome, between work and wealth, will remain stubbornly wide. Not because the system is secretly evil, but because the system is optimized for something other than fairness. It is optimized for efficiency, for capital preservation, for the smooth functioning of markets. Those are not the same thing as human flourishing. The Federal Reserve doesn't set interest rates to hurt Tyler. BlackRock doesn't buy up real estate assets to make his rent unaffordable. The IMF doesn't impose austerity to punish ordinary Greeks. These institutions make decisions based on the logic of the system they were built to serve. And that system has produced extraordinary things. Global poverty has fallen. Living standards have risen. Markets have created wealth at a scale history has never seen before. But the distribution of that wealth is not random. It follows a pattern. It flows toward those who hold assets, toward those who understand the rules, toward those who were already inside the structure. So maybe the most important question isn't who controls the global economy. Maybe it's a quieter question. Who taught you how to read it? Because the people who understand this system, who can see its levers, its incentives, its structural biases, are not waiting for it to be fair. They're using it exactly as it was designed. And the gap between those who understand the system and those who don't is widening every year.